All right, welcome everybody. Let's get this show on the road. Thank you for joining us. Let me just turn it on so we can see our amazing guest today. We've got a show for you. All right, welcome everybody. Great to see you to Masterclass number 10, where we're going to unlock the secrets to infinite banking to build wealth and unlock tax efficiencies. Now, let's be honest, tax not a great topic, so we brought in the best of the best, lots of energy, lots of fun here just for you. But before we do, let's do a quick round table. Who's in our room today? Zach, do you mind starting it off?
Yeah, thanks for the handoff, Jason. Glad to be here. Just wanted to confirm everyone that's tuning in, just make sure you can see us okay, you can hear us. And yeah, any issues with the video or the sound, just put a comment in the chat box and we'll do our best to fix it right away. My name's Zach Cahill, the founder of the Real Estate Hub, and I'm super excited to be joined tonight with Darren and Martin as our guests to go over everything related to the infinite banking. And yeah, just super excited to have them on as the guests. And you guys are definitely in for a treat tonight. With that being said, why don't I hand it over to Andrew? Looks like your name is fixed as well, or Andrew McDonald over there.
Yeah, it's supposed to be MacDonald. Technical difficulties, anyways. Doesn't matter. People know where to find me at this point, I think. If you've been watching the other ones, you'll know who I am. I'm Andrew MacDonald. I'm an investor-focused mortgage broker. I've been doing that since 2015 full-time. And that's pretty much all you need to know about me. I think Milena is our other regular here, so I'll pass it over to her.
Guys, what's up? I'm Milena Cardinal. I'm the real estate investor's lawyer, and I'm so stoked to be here. This is one of my favorite topics to talk about these days. It's in every conversation. It's on everybody's lips. I love, love, love infinite banking, and can't wait for Darren and Martin to start explaining that to this group tonight. All right. So I'll pass it over to you, Darren.
All right. Good evening, all. How's it going? Hope everyone's having a festive night of soon to be discussing death and taxes, my favorite topic. What could possibly go wrong? So there we go. So thank you for the opportunity. It's great to see old friends and meet some new ones. So thanks for that. So there we go. So if you guys have questions, pop them in the chat. Martin helped me to do the technical bits and pieces. I'll introduce myself quickly, and then Martin can introduce himself, and then I'll come back to me. So my name's Darren, founder and CEO of 33/7. We are a wealth creation boutique specializing in propelling and preserving wealth for the affluent. We do not like taxes very much, so we have quite an elegant solution to help you guys keep more of your money, then give it to Andrew, who will then get you a mortgage, and then Nolina will do the legals, and then you go buy multis. So multis seem to be the best and the brightest spot in real estate these days. I'm a big fan of the multis, and we do a thing called a back-to-back. So before you buy your next multi, talk to me, and we'll make your taxes disappear legally. So there you go. That's me. I'm 48. My favorite color is green. I'm from South Africa. I live on a farm. I have a dog, 3 kids, and a shitload of plants. There we go. That's me. Martin, over to you.
Yeah, thanks, Darren. Hey, everyone. Yeah, partner in crime with Darren here for what, 15 years now, Darren? Right, about last longer than most marriages, I've heard too. So, I've got some good staying power, the two of us. Yeah, like I said, I've been doing this for almost decades. McMaster, secondary, post-secondary there, living and raised in Etobicoke though, with got a little baby daughter with me, with my wifey, and chocolate lab that's 15 years old and a cat that's 17. So I've got a lot of old pets, but young humans. So we're having a great time here, and we love to help out folks when it comes to the infinite banking concept and get them on the train where you are not paying tax and you're actually keeping that money for you and your family. So looking forward to it.
Excellent. Thank you.
All right, so there we go. So in no particular order, I'll just start sort of at the beginning. Sorry, Zach, Karen.
I'm just going to jump in quickly. My name's Jason. Obviously, I'm the coach on the team. I specialize in turning your investments into assets, not a job. And of course, it is an absolute pleasure, Darren and Martin, to have you on the call. We typically just go through, as those of you who've been watching our presentation for quite some time now, the last 10 sessions, know you can find all the previous sessions in our Facebook group. But do us a favor, drop a comment in the Facebook group down below. Leave a comment, let us know where you're calling us in from. And are you watching this live or the replay? Keep us up to date. We are monitoring. All right. So Darren, you were saying something, or Zach, you had a comment there?
Yeah, Darren, let me jump in here for 1 second, then we'll ask you the question that I think everyone's been waiting to hear. I see some comments already coming in. So we're gonna run for this session for I think it's a 3-day session. So I hope everyone brought their overnight clothes. We're going for about 3 days. No, I'm kidding. It'll probably be about an hour, guys, give or take. Sometimes we go longer, sometimes it's shorter. We'll see how we're going. And yes, Gilmore, this event is going to be all about the infinite banking related to life insurance. I've actually had like my blinders on, I think, for the last 2 years on this topic because I just didn't understand it. And then I was actually introduced to Darren and Martin by Milena. So just really looking forward to and as we're getting into this, I know you guys are going to have some questions. So put them all in the chat box, and we're going to answer every single question that comes in the chat box to the best of our abilities as we get through this. So Darren, I wanted to hand it to you because I think you explained this like very well. Like, just talk to us about infinite banking. Like what is it?
Okay, sure. So there's a lot of different terms. Some people call it infinite banking. Some people call it an immediate financing arrangement. Other people call it the Rockefeller method. There's a ton of names out there for it. Ultimately, I'll just explain to the concept. The concept is very simple. The concept is based on how to minimize tax and how to maximize your retained earnings in certain ways. So the solution is based on 2 transactions. The transaction 1 is you need a corporation. So you've got to be incorporated. You have to have a corp, right? This does not work if you are salaried. If you're salaried, there's a different solution, but we're not going to talk about that on this call. So anyone who has a corp, a PREC, if you're a real estate guy, any holdco, opco, family trust. So you have a corporation. That corporation generates income, right? So you make X amount of $100,000 a year, and that's happy days. When you take money out of a corporation, what happens?
Government takes a cut.
Yeah, the government takes a large cut. I don't know about you guys, but on the farm this morning when I woke up, I didn't see Trudeau show up at my shift, right? And I did a 12-hour shift, and he wasn't there, but he wants 50% of my money. I'm like, pass. No bueno. I don't want that no more. So how do we do this? We have a corporation, money comes in, it's called corporate retained earnings. So let's say you make $500,000 a year, whatever the case may be, and you need to live on $100,000. Just easy math, right? If you take $100,000 out of your corporation, you have to pay tax. They say you take it out as a dividend in Ontario. The dividend tax rate is 36%. So keep the math simple. Stay with me in the macro. The numbers are not going to be 100% correct, but let's just get the concept down. So you make 500 in the corp, you need 100,000 for gas, groceries, and school and trips and other business. So you take $100,000 out of your corp. However, you have to send $36,000 per 100 to Trudeau and his merry band of, this is recorded, so let me be careful, and his merry band of people. Yay. All right, so there we go. So you lost 36 G's on your first 100. Take out 200, you can follow the math pretty quickly. So that's pretty bad. So how do we do this? All right, so very simply, to get that number to 0, there is a very elegant way to do it. What you would do is this. You take $100,000 of corporate retained earnings, and you would send it to Equitable Life Insurance Company. Just use Equitable as an example. You would buy a life insurance policy on your life, owned by the corp, paid for by the corp. All right? So $100,000 goes out. That's your salary. Right? Your salary just went bye-bye, off it went to Equitable Life Insurance Company. So now what you've gotten is you've gotten a corporate asset based on your life, and it's life insurance. Easy math, $100,000 of premium goes in, you get $1 million of death benefit, right? That means that money for other people, right? So which is not that attractive because you're dead, but you like your family, so happy days. So how does that work? So very simply, 100,000 went out, got a life insurance coverage, happy days, all good. Transaction number 1 completed. That in and of itself is not particularly sexy. It gets a bit more interesting with transaction number 2. Transaction number 2, we go to a bank, any bank. Let's use Scotiabank as an example. You go to Scotiabank and you say, hey, Scotiabank, can I please get a loan from you using the policy as collateral for the loan? All right? So you pledge the policy as collateral, right? Scotiabank goes in first position on the policy, right? And then they give you back the 100,000 of premium. So follow my flow. 100,000 went out, that's your salary. Scotiabank gives you back $100,000 personally. They send it to your personal checking account, 100 grand, right? Now, if there's any accountants in the room, they're going to start going berserk in the chat. They're going to be like, it's a shareholder loan, it's got guarantee fees, yada, yada, yada. All incorrect. Because you're actually not loaning from the corporation, the bank is sending you a loan. That $100,000 is a loan. Loans are not taxed at all. They're not deemed as income in this country or any other country for that matter. Therefore, you've taken $100,000 of corporate money, that's gone. Now you get $100,000 as personal money. What is your tax rate on a loan? It's a donut, 0. So you just saved 36 grand in tax. Can I leave now? Because the sunset is beautiful and there's a hot tub and I just want to roll, right? So there we go. That's the entire concept. Yes, there's nuance, but that's it. 100 out, 100 back, bye-bye tax man. All legal. It's been around for 100 years. It's not been challenged by CRA, yada, yada, yada. And anyone in the real estate business, if you start thinking, basically it's exactly the same as a real estate transaction. It's identical. The physicality of it is very, very simple and very similar. And that's where I'm going to stop and see if there's any questions from my last little diatribe.
So I'm thinking, I wish Vedran was on this call. That'd be a good fit. But my first thought is, I guess for me, it would be, so it sounds like as soon as I do that, how would that affect my approvals with getting mortgages is the first question that comes to my head.
Very good question. Right. So when you enter into this arrangement, you start leveling up in sophistication, right? You're not going to go to a random mortgage broker that's, at CIBC and be like, hey, can I get a mortgage? They'll be like, what's your income? 0. They'll be like, oh, okay, pass. Every single bank now, credit union, have specialized banking teams that use your personal net worth and they underwrite you based on personal net worth and corporate earnings and corporate assets. They do not look at your T1 at all and your NOA. They just don't, right? It's way more sophisticated. So any mortgage broker that has half a brain cell can get you the exact same mortgage, even though you have no income. And it's not like you're going to like a private that's going to cost 10%. You get standard rates, prime, whatever the case may be, at standard banks. So you don't have to worry about that. Also, the loan from Scotiabank does not show up in credit. It does not decrease your domestic borrowing capacity, and it does not mess up your debt service ratio because it's a ghost loan. It doesn't show up. It doesn't exist. Therefore, you can continue to borrow as if you have not borrowed the loan. So far, so good?
Yeah, see, Andrew, do you have any comments on this or jumping in there at all?
I mean, I have
mortgage broker, so I'm looking at you.
Yeah, I have lots of clients that are affluent. They don't typically mention that they've done infinite banking to me. I never see it on their credit report. I never see, multiple Scotiabank loans that they've taken year after year after year to do this, or anything to that effect. Anytime there's a large loan, it's either, it's a vehicle payment or it's an actual mortgage on a property. So what Darren is sharing, I'm sure is correct based on the number of people I've dealt with, and I know some of them are using it. The only caution I would have is, if you're reducing your income, obviously that's going to impact your debt servicing ratios, but we can talk about a balance between how much you're doing to avoid taxes versus qualifying for mortgages. And that's always a conversation for self-employed people anyways.
Got it. And Darren, you mentioned like you love the multifamily investment, and that's probably aligns well with the clients that are utilizing the infinite banking because they can get commercial financing and the lenders are going off in net worth versus trying to buy your primary residence to move in. It might be more challenging. So kind of once again, getting the advice from the mortgage broker, accountant, from Darren's team, legal advice is you can probably make like a custom plan for each your scenario, right?
Yeah. So let's talk about you mentioned the principal residence. Let's say that you want to buy a property personally for whatever reason. Right. So let's say this is $1 million purchase and you need to put 20% down. Okay. So you have corporate money and you got to pull out $200,000 out of your corp to put the down payment on a personal purchase for whatever reason you want to buy a purchase personally. Right. You would then lose $72,000 in tax. Right. Or you could use the Scotiabank loan that came to you with no tax and you can go and buy a private residence personally with 0 tax. So you can actually siphon money out of your corp and go buy personal property and not get dinged like crazy when you're putting down payments on personal property. That's another good thing. So you can use this tool as gas and groceries or investment. If you use it for investment, the interest expense is tax deductible, right? If you use it for gas and groceries, it's not. The interest expense generally on this is prime. Prime's at 6 and change. Happy days. So there we go. So it's not egregious. And obviously, if it's tax deductible, depending on your accountant prowess, it can go as low as 2, 3, or you can keep it at 4, whatever you desire.
I have a question. You guys know exactly what I'm going to ask. This interest rate, if you borrow year after year after year, because you're using the money to live on. So if you do this 100,000 maneuver once a year, every year, so that you can have that 100,000 every year, you're stacking the loan. How do you deal with that? Now, full disclosure, I know the answer because I've been working with Darren and Martin and figured it out this week. So yeah, tell us.
Right. So there we go. So the easiest and best way is to do a back-to-back. And the back-to-back, once again, is going to be property. So before you buy the multi, you would do the tax-free zone. And let's say you only need 100,000 for gas and groceries. You do a $200,000 premium. You use 100,000 for gas and groceries. You take the 100,000 and go buy a piece of a multi, do a syndicate or whatever the case may be. The multis we have are cash flow positive. The cash flow positive nature of that multi would then service the interest expense. Let's use a cap rate of 7%. You buy the multi today. In 10 years' time, it doubles. And then you can sell the multi in 10 years' time to collapse the loan of the tax-free zone. So all you're doing is you're just going round and round in circles like that. So yes, if you're very young meaning if you're 50 or below, you need to make sure that you service the interest expense and the loan. You cannot let it ride because the interest will accumulate over time, and it affects the internal rate of return of the entire solution. If you're 60, just borrow everything. You die, the death benefit pays the bill, and then whatever's left over goes to your family, right? So depending on age, we are very, very much looking at what sort of property works for you. So you can buy a shit box in the middle of nowhere, renovate it, put some tenants in there and go for it. Obviously, single family homes are super tricky at the moment. That's why we go for multis, but that's how we do it. So yes, thank you, Melina. You've got to this is financial stewardship, right? This is not the George Foreman grill. You don't just set it and forget it. This is a piece, it's a part of your overall wealth creation strategy, right? So very important to service that.
And what if I buy all of these policies to help me, offset my income, to put into investments over the next 10 years? Those policies require payments every year. What if those payments are too high after I retire and I just can't keep up with them?
It's a 10-year program. So it's, in this example, it would be $100,000 a year for 10 years. And in 10 years' time, your policy actually has more money in it than you put in. So if you put in $1 million, it probably is 1.1 million. Don't forget, you can always collapse the policy whenever you want, right? So you can use it for 5 years, pay no tax, and then be like, I'm going to cancel the policy, call it a day. The cash value of the policy pays back the loan, the tax savings. Okay, you have no life insurance, but it's done what it's supposed to do. 99% of people don't do that. They have a more robust way of servicing, which we just discussed. But there are a myriad of options on how to service the debt, the loan, how to structure it, and all that good stuff. But I think for today's call, I just want you guys to understand the macro. Like, how does the linkages work? How does the cash flow work? What's the process? That kind of thing. And then we can go super deep on individual calls if you guys have any interest.
Got it. And I know, Darren, we did go super deep, and you were sharing me that example about like basically investing $100,000 a year into the life insurance policy, and you were showing me like by year 5. Can you talk about that? Like what happens kind of at year 5? You're definitely the right person to explain it.
So year 5
that she's had, right? Because if you can bear with me for a second, I can get that document up and running for you.
Yeah, while you're trying to get that up. So yes, your cash value, internal rate of return of the policy, and it generates cash, right? That cash grows over time and grows. Put in this example, 100, 100. So you put in 500,000. In year 5, you can actually pull out more money than you put in. So I can't see the screen. I'm on a mobile phone. There should be like a couple of $1,000 extra. But if you look at year 10, you've put in $1 million. and you probably, I'm just going to guess, is like 1.1. So in year 10, you contribute 100, but you can actually pull out 200. So you have an extra $100,000 of cash that you didn't put in. It's just there. It's free money for you, and it's tax-free. It's kind of handy. I can't see that for level money.
Very blurry, but it looks like 1.2 actually.
1.2, yeah.
Oh, yeah, there we go. So 1.2. So there we go. So you got an extra 200,000. So in year 10, you make your contribution of 100 grand, and you can borrow back 300. Kind of handy, right? So that allows you, it allows you flexibility. It gives you liquidity, reduces your tax to zero. You can buy multis, et cetera, and because you've plugged the drain to Ottawa is gone. Up, you've plugged it. So in year one, when you save 36,000 in tax, what are you going to do with it? Don't go to Vegas. Like, it's not a good idea. You take the 30 grand and you invest it in something that has a return, right? You can blow it, but if you blow it 5 times, 30, 60, 90, it doesn't make any sense. You want to make sure that the tax savings is used appropriately, right?
So if I'm understanding this correctly, you invest the money, you save 36 grand in taxes, you take the 36 grand savings, you invest it in something that generates a return, you use the return to go back to offset the interest that you're paying. And
yes, exactly. Right? You can put it in a MIC or a REIT making 10%. You could become a private lender, charge 10% interest rate with 3% fees. You can do that. Your interest rate's at 6, but it's tax deductible, so now down to 4. You're making 10 or 13. Your delta is pretty good, right? So there you go. So you're servicing the interest rate all the time. The interest expense, sorry. You're servicing the interest expense all the time by investing the money prudently with, I'm sure there's 10 people on this call that can, invest your money correctly, or can put you into multis, which once again has an income stream, right? Because you offsetting. So you got income coming in, you got a loan going out, that takes care of that. You got a loan growing, but you got a cap rate growing on your properties, and everything is lockstep working together. So it's a team approach. Hence, it's called a back-to-back.
Got it. So if I'm understanding that correctly, like you're talking about pulling out, let's say 200,000 from the life insurance line of credit, let's call it that. 100,000 would go into funding your lifestyle, let's say, and the other 100,000 could go into an investment. The one that goes into the investment can actually service the debt on the full 200K.
Correct. So you've got 100 plus the 36 savings. So you actually got 136,000 to service the loan, right? So I can add one level of complexity, and this is for bigger policies. So I've just shown you the circle. That's how the circle works. There's another circle, a smaller circle within a circle, where you can actually take, because you don't need 100 grand on day one, correct? You're going to get $100,000 in your checking account. You're not going to spend $100,000 in a month, unless you have a really fun month. But you only need, let's say, 10 grand to live on, right? So you can do that. What you can do is you can take the 90,000, right? Lend it back to your company, right? Invest in a step down REIT or a step down MIC, which is 90,000, and then month 2 is 80, 70, 60, right? So you can actually reinvest your salary that's now making 10% on 90,000, 10% on 80, 10% on 70, 10% on 60, and you can draw down over the year, but you're making more money on that as well, right? So you can become highly optimized and extremely efficient, because now you're adding income stream after income stream after income stream, all just to service the interest expense, right? And we can show you the math on a model. It blows it out the water, right? So you're not ever going to be caught with your, once again, a recorded line. You're not going to be caught with your pants down with this massive loan and a huge amount of interest to service, because then the whole thing falls apart, and then we're not friends, and that's not bueno.
Okay,
I can confirm that that's the case.
Yeah, just went
through the entire exercise.
Yeah, so just understanding that point there. So essentially, you would get that $100,000, let's say, in your TD bank account. You're not going to spend $100,000 in 1 month, so you can just invest 90,000 of it and then make draws as the investment come out each month to increase the return.
Yes,
yeah, that
correct.
sounds amazing.
Yeah, that's the second circle, right? So we're just adding more and more line items that add more wealth to your bottom line. Okay.
Wow. Can I ask a quick question on the example you have up here? So we've got premiums are $100,000 a year for the first 10 years, and then each year you're building the cash now value. So can you explain the difference between the premiums and the cash now? Is that essentially the actual insurance premium for the life insurance component, or why do you not get the full 100,000 access in year one, for example?
Right. So these numbers are directly from the insurance company. So in year one, if you don't go to Scotiabank, right, to get the 100 back, you can just press one button at Equitable and they'll give you back, I can't read that, 78 or something.
76.
$76,799.
So the insurance company will lend you back 76% of the money you put in within 24 hours. You press the button, 76 grand comes back to you immediately. So there's a shortfall, the delta of what's that, 28,000 or whatever. That delta, you can be like, oh, I don't want to do the paperwork. Scotiabank's annoying. Or you can go to Scotiabank and get the full 100 back. Right? It's up to you. You can choose. Yep. So if you look in year 5, there's a deficit until year 5, and then you're break even, so to speak. But if you go a third-party financing route, you break even immediately. Year 1, 2, 3, 4, and 5, then you're back in the juice and you got more money coming in than you put out. Right?
Okay. And then is there a difference in terms of the rate that Equitable would lend it back to you versus Scotiabank? Or are they both kind of around prime?
Prime. Same.
So it's just convenience, essentially.
It's convenience, 100%. And Equitable Life Insurance Company and all life insurance companies don't charge you fees. So if you go to Scotia, there's an origination fee, it's $500, annual review, $500. You know, there's some fees because they're banks, right? And banks are wonderful, yay. Whereas it just depends on what you want, right? A lot of folks are like, I don't want the hassle. I'll just press the button and get 76 grand back. Other people are like, no, I want to build a relationship with the bank. I want to get, into Scotiabank private banking, which is, we have a relationship there where you can get, a PB. And then you pay some fees, and then all of a sudden you've got a concierge team around you and blah, blah, blah. And they send you a coffee mug at Christmas or whatever they do. Yeah.
Or you want to buy more multis. So
there you go. Yeah. By the way,
it's nice not to have to qualify, though. I got to say, like, not to have to go through the hassle of qualifying.
Yeah.
Paperwork is one thing. The blood samples they want these days are another.
Yeah, we actually, in most of our policies, we physically actually need blood and urine. And then you go to financing and then they just undress you and shower you with ice cold water. Yeah. So it's actually not that bad. The process isn't that terrible. But yeah, it's the worst part of this is dealing with the bank by far. The insurance company is easy. Like, there's no problem. That's a no-brainer. But yeah, the banks are tricky. As you know, anyone who has ever bought a piece of real estate, it's not pleasant. It's just not. Yeah.
Got it.
But
nobody in this room knows what you're talking about, Darren.
Exactly. Yeah. You guys are all newbies. Yeah.
Yeah, and I want to ask you down the line too, like just remind me later, like, what is the process if you wanted to kind of start something like this with the qualifications at the insurance company and the lenders, because I think that's going to be really important. But before that, like who do you recommend this policy to? Like are there certain types of people? Are there people that you don't recommend it to? Are there, I think what put me on the fence for the longest time about advice, right? I find that with everything, there's a lot of commission-based advice and there's different insurance programs and what are the different insurance programs out there, Darren? And like who would you recommend this policy to? Do you recommend other types of insurance?
Yeah. So I'll camera back for a second. So like Martin said, we last longer than most marriages, and we do, right? So there's 3 things that you have to firstly ascertain. First, do you like me? That takes time. Then do you believe me? And finally, do you trust me? This takes time, right? This is a lifelong relationship. We never leave, right? We're like bad in-laws. We're just around forever, all right? So this is not a commission-based thing. I've stopped worrying about commission years ago. I've done this for 17 years in this country and 10 years in 5 years in Manhattan and 5 years in Tokyo. So yeah, the commission thing is long gone. I have no interest. But what I like is puzzles. So putting together complex solutions, the puzzle is what I enjoy. So yeah, we're commission-based, sure, but we don't leave once the transaction is done. It's a relationship-based and it lasts a long time. So just to assuage any fears over there. So that answers that. What is the part 2 of the question?
Yeah, just curious of what are the other types of insurance just in general? And I know when I talked to somebody else at one time, they're like, pay this fee monthly.
Yeah. So once again, I think on this call there's a level of sophistication. So surrounding yourself with the best people. You're in mastermind at 7:30 at night. People actually give a shit. They're here. So there we go. So yes, there are 65,000 insurance agents out there, and there's about a dozen which I would work with. We're ranked number 3 in the country. We've done this quite well, and we have monster size. Therefore, we get the best rates and blah, 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 blah. So yeah, you need someone who actually owns it, has done it. And there's a ton of people that you can say, oh, call this person, call this person. Well, this guy owns 400 doors. Call him. He has 3, right? That kind of thing. So the credibility is from the experience. The different products, basically in this country, there's only one product. It's called Participating Whole Life. Participating Whole Life is the only one that works in this solution. If you buy term, you're buying, it's just a waste of time, right? And then there's another thing called Universal Life. Universal Life is a very, very sophisticated solution for ultra high net worth people. And unless you're worth a shitload of money, don't play with Universal Life. Advisors sell Universal Life because it's easy, right? The numbers look better than Participating Whole Life because on paper, they stack them differently, right? So if you buy Universal Life, be careful because you don't know what you bought because the advisor that sold it to you doesn't know jack shit about mathematics. And he won't be there in 5 years. And then you're stuck with this monster that is highly complex. We do 1 a year, maybe 2, with net worth 50 million or more, age 70. So if you're 70 years old and you're worth 50 large, call me and we can do a UL for you, Universal Life. Otherwise, keep it simple, stupid. Let's just go kiss all day long, right? This is the bog standard vanilla. It can't be challenged by CRA. It's been around for 100 years. And it just works. All right. So Participating Whole Life, that's where you want to play. All right.
Love it. Thank you.
You're welcome.
Along those lines, could I ask for someone who doesn't care at all about life insurance? Let's say, you've got cash in the bank to cover the cost of your funeral. You've got enough other assets your spouse would be taken care of, no children, no dependents, no causes that you care. You're the least charitable person in the world. Does this still make sense just for the sake of not paying tax and getting income out more effectively?
Yeah. So this is a solution called the tax-free zone. We call it the tax-free zone. I couldn't care about life insurance. If we could do this with scoops of ice cream and kittens, you'd be long dairy and there'd be fur in your house, right? I don't give a shit about life insurance. I care about the solution. What if you come to me with a problem? You're like, I have this problem, solve it. I'm like, okay. So we use different strategies. On this call, this is the strategy that solves immediate tax relief for income tax, right? And we haven't even scratched the surface on how sophisticated we can build this, right? Because it'll overfill the teacup and I'll be here until 11 o'clock. But yes, it's got nothing to do with life insurance. Life insurance is a bonus. Even if you don't care about anyone, right? When you die, 25% of your estate goes to Trudeau, all right? So if you're a happy taxpayer, pay. I don't care. It's not my problem, right? So it's got nothing to do with life insurance. It's just part of the solution, all right? So yeah, because most people, when you hear the word life insurance, what they want to do is they take a can of gasoline, they pour it upon themselves, and then light themselves on fire because that's how shit the product is, generally speaking, right? So yeah, so that's why we never use the word life insurance because you don't care about it, right? It's a bonus if you care. If you don't care, do you want to pay tax or not? No, you don't. You don't? Call me. If you want to pay tax, call Trudeau. He'll take all your money. Right. Does that answer your question?
It does, yes. I think we're on the same page there.
Can I go from the opposite angle of this? Like, we've talked about the value of this, and there's no brainer. The numbers look amazing. And you've said at the beginning, this is for corp, not for personal. Who would this not be for?
Salary people. So you have to have a corporation because you're doing arbitrage. You're arbitraging your corporate tax rate versus your personal tax rate, right? Yep. This is all about moving money through the ether legally, right? So a salaried person gets a salary, half the money goes bye-bye, and then they buy this. Where's the upside? The upside for you, Andrew, is it's pure life insurance. It's a life insurance play with a piggy bank attached. That's what it is, right? It's a store value. It makes blah, blah, blah. So if you're salaried, like I'm a magician, not a wizard. Like I can't help everyone, right? So you have to have a corp that makes money, right? So that be very specific. We're business owner focused only. Right.
Now we do have a couple of we've had lots of questions on Facebook. So just unless does anybody else have any other questions before I go back through the list and get some of these questions answered? Not hearing anything. All right. So we have one question here. So for infinite banking, this is coming from Clinton. You can use whole life or whole life. What do businesses prefer to use? Whole life, you can access 90% of the investment. Depends on your investment risk. You can only access 60 to 90. Not really sure what the
I think that was the ultra.
Yeah, I think it's more around which one would you use.
So whole life, you only use whole life, and you can access 100% of the premium immediately.
Got it.
Based on your financial wherewithal. From a net worth perspective, minimum net worth $2 million, which is laughable because if you own a house in Toronto, you're worth $2 million, right? So generally speaking, net worth 5 million and over is the easiest to get you underwritten from a banking perspective. But obviously, if you're using the insurance company you don't really need a big net worth because they don't do financial underwriting per se, like a little bit, but not too much. Whereas the banks, yeah, no clothes, cold shower. Here we go, right? So there we go. Okay.
How does it work, Darren, if you have, let's say, like multiple, I got a bunch of questions written down, guys. So how does it work if you have, like, let's say, multiple corporations or multiple different businesses? Like, do you have clients that own these policies in each one, or?
No, you can do a cascade. You can buy as many as you want. This is not a one and done deal. You can buy as you scale in. You can buy one today. In a year's time, you can buy another one. In 5 years' time, another one, et cetera, et cetera. So don't forget, the way they underwrite is they underwrite from a personal net worth standpoint, the entire ecosystem, your ecosystem. And then we find out where the best corporation is to own it and hold it, right? You might want to set up a brand new holding company, put it in there, right? We might want to put it in family trust. Generally speaking, we don't want to put it in operating companies that have risk, generally speaking, right? But within the org chart, we'll find somewhere to put it, or we'll create something which makes sense, whether it's in holdco or a family trust, right?
So that leads me to a question from Elena on that. So you always talked about the holdcos as a very vital piece of our security net. Does that cause any issues for a holding co having something like this in there?
That's a really good question. I often even refer to them, the one at the tip top of your pyramid. I call that a clean co to remind my clients to keep it clean. And ironically, I bring up infinite banking pretty much every time I talk about a clean co, because I'll say the only thing you can do with this corporation is to own assets or to invest in things where the only risk is losing the money you're putting in. Things like private lending, owning shares of other corporations that buy buildings and run businesses, life insurance, infinite banking, right? I say if you're into the stock market, go and buy your stock in that corporation. So when I talk about the clean co is where I usually recommend doing infinite banking. Now, in my case, I'm doing something slightly different, but typically the recommendation is to do it in what I call a clean co, or the hold co that's at the tip top, not the hold co that's holding your properties.
Okay, thank you, Zach. You had more questions?
Because you can dividend if your clean co owns the corporation that owns your properties, right? So clean co, corporation that owns your properties. So you will dividend out to your clean co when the corporation that owns the properties makes money. You can dividend it out to your clean co for free. So the issue, or for free or tax free. So the issue is not that transaction. That transaction is not an issue. The issue is when you take the money out of your holdco into your personal name, that's when the tax bill is high, and that's what this avoids. So it's fine to have the policy in any of your corporations, but might as well have it in something clean, where there's no risk that the life insurance or the cash value of your life insurance could be at risk of liability from the other assets in your corporation.
I see. So like most things, it's you need the real estate investor, lawyer, accountant, and mortgage broker and life insurance expert on the call to make that decision.
Yep.
Got it. I got a few questions here, Darren, and then we can hand it over to the Facebook chat before we wrap up. But like, is there an age restriction on this stuff? Like, can you have the policy on your kids? Like, how does that look like?
Age restriction is the youngest you can do is 31 days old, 31 days old. It's called a head start.
Almost
From
there.
31 days to 16 years old, it's called a head start, and you can get your kids sorted out. Beautiful, and I'll get to that in a second. The top upper limit is 75 years old. All right, that's your age range. When we set up things called cascades, we can do 3 generations, 4 generations at the same time. So your mom and dad, you, your wife, and then your kids. We can do 3 generations, 6 lives, 8 lives, 10 lives. Those are the most sophisticated cascades in the world. That is called the Rockefeller method. All right, and that brings me to a point. So the Rockefeller method is interesting. It's 2 families. One's called the Vanderbilts. One's called the Rockefellers. The Vanderbilts, broke, live under a bridge, gone, finished. The Rockefellers, lots of money. So what the Rockefellers figured out was they had a problem, and their problem was dilution. Dilution is you have mom and dad and you have 4 children. Let's say you're worth $10 million. You love your kids equally. You got to give them $2.5 million each. You've diluted your estate, right? 2 of them get divorced. $2.5 million is gone. One guy is a drug addict. That's gone. And then the one guy is an awesome dude. He makes another 10 million. So he gets back to generation 1, right? So that's dilution. Dilution is a disaster for high net worth families, right? So the solution to dilution, which is trademarked, by the way, the solution to dilution is you load your kids with life insurance, because every generation that dies, the money pays into a trust. Then the next generation pays off the loan and the money stays there. Next generation pays off the loan and goes in. So the more children you have, you can put them on payroll. There's a certain ratio, which we'll explain to you on a personal call, where you can get as many generations on this from 75 to 31 days old, and we can build extreme wealth. So the Vanderbilts, not so good. The Rockefellers, they don't do anything. No work, no job, no nothing. And every generation gets richer than the generation prior. Very powerful. And that's what highs and ultras do, right? So families that are worth hundreds of millions of dollars, they have this solution to dilution, and we provide that for them. All right.
So just before we continue, I just had to correct something. That is not a reason to have a 3rd child. So I just had to get that nip in the butt immediately.
Yeah, no. The kids are pretty expensive. So put them on payroll early. 31 days, call me. We'll get those little suckers on there so that, we can take care of them.
Jason, has she reached that age yet?
Just about.
Yeah.
She's borderline.
Wow. Okay. Oh, I wanna keep going here, but I know I'll be keeping you all up all night, Darren. Like, talk to me about how is this a win-win? Like, how does everyone win from like working with you guys and getting the policy, like in terms of the insurance company, the bank, like how does it all come together as a win-win in terms of like everyone getting paid?
Sure. Well, insurance companies, they own stadiums. They know what they're doing, right? They've got an actuarial team. They take your premium, they invest it, they make a shitload of money. You don't die for a long time. They're investing $100,000 for 80 years. So they know how to make money. Banks charge interest. That's how they make money. I get paid a commission, one shot up front. Happy days. I will disclose that to you if you wish. That's how I make money. And the client pays no tax. Happy days. Has a back-to-back, can buy more stuff, and has a really low capital rate, right? Because you can deduct the interest and and et cetera, et cetera, et cetera. So the person that wins the most is the client, right? Then when we do dive deeply into these, we'll show you the numbers and find me an asset class that does better than this, and I promise you I'll buy it. I swear to God I will, because I'm looking, because I'm in the same business as you. I have property everywhere. We have multis. I have a house in Mexico, yada, 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 right? So we're constantly looking for solutions. I'm solutions based. I'm not a life insurance salesman. I don't have gray shoes on and a pocket protector, right? We're just here to provide a solution. And if you have something better than this, please tell me, because I would buy it tomorrow.
Wow.
Awesome.
Right. So I'll jump into some Facebook comments. I had one from John here. So you just said we're not a business owner, but you have 9 doors over 3 properties that all cash flow. I sell one and now have 150K. Is that something I can take advantage of before I find another multifamily property?
The question is, are those personally held, or are they in a corp? Is the cash flow spinning into a corp? Because if it is, that's handy. If the assets are held corporately, 100% we can help you for sure. And to service the interest, keep a couple personal, put a couple in the corp. Happy days. Absolutely, yes. So if you're salaried, great, but make sure that you speak to Melina, get a real estate corp up and running, and then split your assets. One to service the debt externally, if you're taking it for gas and groceries. If not, bang everything in the corp, borrow, get the life insurance policy done, and then just go buy your multis anyway. So yes, before you buy the next property, do the tax-free zone before that, because you've doubled up, right? You're using $1 twice. Money goes out, money comes back. By the multi, you have 2 assets growing with $1 used.
Yeah. It sounds like once you could just open up a corp and then move that money from the sale into it and then buy the policy and then buy real estate. But again, talk to Melina.
This is all structuring. Yeah. And it's, we're on the call with your accountant and your lawyer, right? We quarterback this, but you need your professional services team with us. We do not work in a vacuum. We work with your existing professional services team. If you don't have one, we'll introduce you to what we think is the best in the business, which most of them are on the call today anyway. So there you go.
Do you know what would be really interesting, guys, is to how would this work with the Smith maneuver? We literally just did our last masterclass on the Smith maneuver. I'm in the process of looking to buy a primary residence, and the Smith maneuver opened up my eyes, but I imagine this could fit right in terms of borrowing from the life insurance policy, then putting it down on your mortgage, freeing up that as a line of credit.
Yeah. So how are you going to get the down payment on your principal residence? Where does it come from?
Income.
Well, yeah.
It comes from your corp, right?
Yeah.
So you want to pay tax on that, or you want to get a free down payment down with no tax? Which one you want?
Yeah, the free down payment.
Well, and with the Smith maneuver, you're paying down your mortgage, right? So with the Smith maneuver, you're taking after-tax dollars in your personal name, and you're slowly paying down your mortgage to free up a line of credit, and then you invest that money, and then the interest on the line of credit is tax deductible because it's generating income, right? Mm-hmm. But if you use this method to take money out of your corp tax-free, your post-tax dollar are actually just debt dollars that you're then using to pay down your mortgage. And I've already got a plan to use this strategy to do the Smith maneuver.
Yeah, you thought about that too? Because that's what I'm thinking, like, genius.
Now my money's working 3 ways for the same dollar.
You got those of you that are watching this call.
Right?
Sorry.
So I've been thinking about this since the last call, because we talked about Smith maneuver. Okay, we're going to do infinite banking next time. So I'm thinking, like, you got to kind of balance the qualifying. You got to make sure you're set up with the product that allows you to do the Smith maneuver. But then if you start doing this, think about all that money that you're not paying in tax you can now use as your prepayments to pay down your debt faster, and you're still already set up on an auto pre-advanceable home equity product that's going to come back to you. So it's like the two of them just accelerate each other. You just have to be careful about the qualifying.
So the tax-free zone is the precursor to the Smith maneuver.
In my case, certainly.
That's in your case, Melina, for sure.
Because I came to the same conclusion that you said this week, which is that, or I think it was last week. Anyway, irrelevant. That I need to save half of the money that I'm getting that I'm borrowing from this, with the collateral as the life insurance. I need to save half the money for the model to work long term and to cover the interest. And so when I save that money, instead of actually just putting it in a savings account until I can invest it, the plan is to put it down on my mortgage, then invest that. So it's just triple whammy. Yeah.
So just to jump off topic for 1 second, those of you who are watching online wondering, what are we talking about? Smith maneuver last class. That was masterclass number 9. It is live in our Real Estate Hub. Be sure to check out the video section. You will find it there, and you will definitely want to take a look at that one. And then after you watch that one, take lots of notes, grab your pen, immediately come back, watch this one again, and take some more notes and figure out your plan. And of course, the last step, one of the other questions that keeps coming up is, where do we find you? How do the individuals watching this right now get in touch with you or get started?
Is that a question for me?
Yes, because I'm definitely not the one setting it up.
So just email me, and you can put the email in the chat, but I'll say it to you very simply. It's my first name, Darren, spelled DERRYN, at the number 33, then the word 7, SEVEN .ca.
Awesome. I just popped both Darren and Martin's email in the chat box. So yeah, you guys want to get some advice, learn more about this, so we don't have to talk for the next 3 hours, definitely book a call with Darren and Martin. I know I'm going to be getting on the call with you guys again to get this started. We already did our initial consultation, and yeah, just really looking forward to it. Great way to. Now I'm going to be up all night thinking about this and the Smith maneuver together. I'll be honest, because it's like it's and then you also add in there like the what would you call it when you slowly like got the reverse money? You got the 100 grand, but then you invested 90 and then 80 and then 70. Yeah, it's like
Step
at that
down.
point, like, can you build a spreadsheet to do that calculation for us?
We already have one. Yeah, we got one. Don't worry, we got all of it down for you. So when we jump into the next call, Zach, with you, it'll be just paint by numbers. It's all written down line by line, and you'll be like, "Holy shit, Batman!" The numbers get pretty big pretty quick. Yeah.
Love it.
I want to get in on one of those calls if I could. I know now the email to message, so we can get started. If you're wondering the same thing, be sure to take action because, yeah, we all know that the results are in the actions taken. It also sounds like a group retreat, or Zach, even better yet, a oh shit meeting coming up. I think I have our topic.
Nice.
Right. Any
I
final
have one last
comments?
question quickly for you guys. Where does 33.7 come from?
Oh, the name? Okay, yeah. So I was doing my master's in mathematics at the London School of Economics, and that's London, England, not London, Ontario, although London, Ontario is hauntingly beautiful. So 33 it's one of the most powerful numbers out of 100. All numbers have shapes. 33 is a recurring number. It's a circle. Circles can't fall through themselves. And when you go camping, there's a three-legged pot. So 33 is perfect for diversification. So a third of your assets goes into the tax-free zone, a third of your assets stays in your business to build business, and a third of your assets goes to property. So those three, they work beautifully together. So perfect diversification is 3. So that's the 33 part. I came up with that all by myself. And then I stole the 7. The 7 is actually 7.2, Fibonacci number, the rule of 72, the 72, right? But the URL was too long. So I truncated it down to 7.ca. So 33.7.ca. So it's a mathematical algorithm for what I believe is infallible wealth creation. So there we go. So I made that up way back in the day when I was still running around London, England.
Awesome. Thanks for that.
Thanks. You're welcome.
Well, thank you so much, everybody. Any final comments, questions? Here's your chance. We'll take one more question from online if we get one in the next 60 seconds or so. And any of our experts on the call, any final comments or questions? Not hearing.
Looks like someone's like just reaching out for your contact info to Melina, so I'll send them a direct message for that. Yeah, I got more questions written down, but I feel like I've hijacked this presentation. So any other comments, Melina, Jason, Andrew?
So for mine, I would just ask for one final summary, just so to make sure, because obviously there's been a lot of information here. It's a tough topic. You've done a great job explaining it, thankfully. Is there one final summary on just to really hammer home the understanding of how this works, or what they need to look at and how to apply it?
It just comes down to what you want. Do you want to use $1 twice? And do you want to reduce your tax bill precipitously? That's it. Tell me what you want, and then I'll make that dream come true. That's it. Because that's what we do. Right? I need to know intimately what you want, and I will make that come to fruition.
Excellent. Well, thank you so much. As always, it's a pleasure having you on the call. Thank you for joining our masterclass number 10, one of the best we've had yet to date. Of course, we have a lot of great calls. If you want to learn about corporations, go check the past. We had the Smith maneuver. We've talked about a number of different aspects. Or more importantly, be sure to sign up so you get notified for the next one. We aren't going to tell you what it is just yet. You're going to have to wait and see. But of course, masterclass number 11, we got a doozy for you. So be ready, be waiting. Until next time, share this information. If one thing's come out clear from this is that we're more powerful together in a room. Let's not keep it to ourselves and keep it quiet. Get that information out there. And if you want to do us a favor, if you like the call, share the information to someone by hitting that share button down below. Get it out there. Get people to know about it. Maybe even your father-in-law if you like them. Right, until next time, thank you so much for everything. See you on the next call.
Thank you.
See you guys.